Hello and welcome back to the Canadian Money Roadmap Podcast. I'm your host, Evan Neufeld. Today we're doing another episode on things new and noteworthy, and we're looking at a couple articles that just happen to be focused on the number 1.7. So that's $1.7 million you need to retire, and 1.7%, which is the investor gap between what you could be earning and what people actually did earn on their investments. Okay, as I mentioned in the intro, we're going to look at a couple articles today. They're not necessarily brand new news here, but I thought they were both interesting and worth talking about here on the podcast. So starting with the first one, I found this survey from the Bank of Montreal, and it seems like they do this on a regular basis, probably annually. They were asking people how much they think they need or they believe they need to be able to retire. And the number that they reported here on average for their survey, which was a professional survey, it's not just like some click thing on their website. It was a professional survey, and they found that Canadians think they need $1.7 million to retire. This is a 20% increase from the amount they reported back in 2020. So that's crazy. It's an incredibly large number, especially compared to 1.4 million, which is probably higher than I would probably expect too. But this is particularly crazy because back in 2019, Stats Canada, they reported average investment balances by account types. And so I just looked at RSPs or LIRA's registered plans, just lumped those together, and TFSAs. And so between those two, the average person over 65 had 429,000. So there's a massive gap between that and $1.7 million here. So first, the amount that anyone needs to retire is specific to them and them only. Yes, there are rules of thumb and guesses you could make, but in my experience, 1.7 sounds kind of high, but for some people, it might be really low because this all depends on how old you currently are. So what if you're 18 years old, planning to retire at 65 or later? 1.7 is probably really low. But what if you're 63 already? Do you still need the same amount of money today? No, it's crazy. So it all depends on how old you currently are, when you plan to retire, how much you plan to spend, and this is probably my opinion more than anything here, but how overwhelmed you currently feel. So I don't think that number of 1.7 million comes from people feeling great and wanting to travel the world and staying at the Four Seasons wherever they go. I think it comes from people feeling like the cost of living is growing so much that they won't be able to keep up. So it's kind of an overreaction probably to what's going on in the world. This leads me to a few points that I want to make here. So what's leading the big change and generally massive number of $1.7 million needed to retire? First, inflation. Everything comes back to inflation these days. When inflation is 8% or 6% or whatever it is now, sometimes it feels like 100%. Because it's just like, it just won't stop. Like things just keep going higher and higher and higher. And it's easy to get overwhelmed with that. Also, because one's personal inflation rate is way more important than the actual CPI number. So that's the Consumer Price Index. But your own personal inflation rate is very, very different than that. Because the things that you buy, whether you like it or not, might have a higher inflation rate than CPI, but it might have quite a bit lower. And from what I've found here, and anyway, maybe this was last year, and the components of inflation have ebbed and flowed for sure. But younger families, those that are needing to buy homes and buy vehicles and buy a lot of food and clothing and things like that, younger families are bearing the brunt of a lot of that inflation, making their future expectations higher because it just feels like, boy, when is this train going to stop here? So I think one of the first things is inflation. And even if it starts coming down, people are currently feeling a little bit overstretched. So their assumption for how much they need to retire is going to go way up. 2, people don't actually know how much you need. So in the survey, 52% said they didn't know how much they actually needed. And I would say, based on the number of families that we work with, anecdotal evidence there, of course, but anecdotal evidence says that that number, so 52%, is way too low. Way too low. No one knows. Like on average, no one knows. Largely, and that's not a fault on anyone, myself included, because that number also changes all the time based on your circumstances. What your investment rate of return was last year, what your expenses are this year. You could get a totally different job and have a completely different lifestyle from one year to the next. Everything changes all the time. And so people that think they know how much they save or how much they need to retire, that number needs to be reevaluated constantly. Not that you need to live in that and be fearful of that and have a lot of unknowns, but yeah, generally speaking, people, you just don't actually know. So number 3, pre-retirement expenses. So people that aren't currently retired, your expenses are inflating your future expectations. Let me break this down. So you feel like you need to save more, you need to pay more for a mortgage now that interest rates are higher. Maybe you're having kids, all these different things that are going on before retirement. These are all pre-retirement experiences only. So once you're retired, hopefully your mortgage is already paid off, your kids are out of the house, and you're not saving for your retirement anymore. So those are cash flow items that you don't really need to account for. So right now, if you're thinking like, oh my goodness, I've got this much income and I'm stretched so thin, I'm going to need $1.7 million. Whereas that's probably not the case. Taxes too. Taxes are much less of a consideration in retirement due to lower income needs because of those other things, like your mortgage is paid off, you don't need to save for retirement, your kids are probably out of the house, all those things. Taxes are much less of a consideration, and the addition of the ability to split income with many of your sources after age 65. So even if you have a single income household, if you have a spouse or common law partner, you will be able to split things like your RSP withdrawals after age 65, pension income, things like that. You can split between the two of you to decrease your average tax rate, which means that you get to keep more of your money, which means you don't actually have to have that much invested because your after-tax dollars will be higher. And number 4, so what's leading to the big change here in this massive number of 1.7, what people think they're feeling. Last one is a misunderstanding of the income sources you'll actually have in retirement. So many people forget about CPP or don't know how it works or think that it won't be there when they retire. That's a really common thing that I run into here. I think this is objectively a poor understanding of the pension and the asset that it is. I have a whole episode about CPP, but I am actually quite confident in the CPP. Especially once you kind of dig into it, no, it is not a government program. It's administered, I guess, indirectly by the government, but it's arm's length, and it's managed by the CPP Investment Board, which has nothing to do with the federal government, and it's a contributory plan, which means that you actually put your own money in it, so it's not based on tax revenues, and your employer puts money into it as well. So the contributions that you put in are actually being matched by your employer. So there's a lot of money in here, and the sustainability of the CPP is very strong. It is one of the best pensions on the planet. So I wouldn't be worried about that. And people also underestimate probably how much they're going to get from CPP. I'm sure some people overestimate too, but many people don't understand how much you're going to get from CPP. Secondly, people largely don't know about old age security, which is another government benefit. It's not huge, but provides meaningful income for seniors over 65. So that's kind of the last thing that I would suspect leads people to think they need so much money. But if you are in this camp of thinking you need 1.7 million to retire, or maybe you do need that much, or maybe you need much more, I would recommend a few things. First, get an idea of how much you need. Just a general idea of what is realistic and how to get there is beneficial. This type of financial planning I've started offering through my Money GPS program, which you can find a link to in the show notes of this episode. Hopefully by the time you listen to this, it's still available. Number 2, you need to start saving or start saving more. No sugarcoating it. The only way to get more savings is to actually do it and do more of it. But, the old idea of raindrops make oceans. If you start small, you can increase it later. You need to do something. And the hardest thing to do is get started first. So make sure you start saving and start saving more, especially if you received a raise last year. Many people did, along with the big inflation increase. So if you got a raise last year, you should be increasing your savings rate accordingly. Number 3, things that you could do, I would say reducing unnecessary expenses today. Because the way you live today is the biggest indicator of how you'll live later, like in retirement. So if you reduce your unnecessary expenses today, you can save more of the cash that you have already And you'll likely need to spend less of it later on these unnecessary things you've already gotten used to not having in your life. So it's a double-edged sword of benefits of creating some extra margin in your life. So you spend less and you're able to save more. Unnecessary expenses, audit is a great thing to go through for anybody. Okay, so that's the first one that I wanted to cover off here. Lots that we could have unpacked there, but I just wanted to kind of plow through that, the basic understanding of how much people need to save for retirement. Second item comes from Morningstar, and the Morningstar is, I've talked about it a few times here. It's a publicly available website, and they do all sorts of reporting on investments. It has nothing to do with advisors or DIY necessarily. It's just they're an organization that provides lots of great data and research about investing. So Morningstar had a report. I don't think it was that new. It did come out in 2022, or the data was from 2022 anyways. But I've seen it circulating here recently and thought it would be worth mentioning. So the report was on investor returns in the United States. I know even though it's US data, I'd probably expect something similar here in Canada, largely because they're reporting on behavior more than the differences of products or taxes or regulation or some of those things that are actually different between Canada and the US. But the report was on the returns and the differences for those people that are investing in funds and ETFs, and how the investors' returns are actually quite a bit lower than what the fund or ETFs returns have been. So over the last 10 years, the average investor return across investment categories, so they had 7 different categories that they looked at, the average return over the last 10 years was 9.31%. However, the returns of the funds and ETFs, which includes active and passive, this isn't an active and passive issue, the returns of the funds and ETFs was 11.04. So it's a gap of over 1.7%. There's that magic 1.7 again. 1.7%. Okay, so this might seem a little bit unusual. It's like, how is that even possible? Let's kind of break this down. So what happened? Well, first of all, this isn't new. So there wasn't some freak thing that happened here. They've run this report in years past, and the results are actually very similar for other 10-year periods of time that they've looked at. And their research is actually pointing to bad timing and the timing of cash flows as being the most significant factor in underperformance. Tax efficiency and investment costs, yes, they are factors, but their research has shown that it's actually much smaller than you'd probably expect. First of all, before we keep going down this conversation here, let's talk about how rate of return is actually determined. So there's 2 different ways of determining rate of return, largely speaking. The first one is time weighted. So that's just looking at the rate of return over a certain period of time. So if you're looking at 10 years, what is it at the beginning? What do you have at the end? And you can figure out an annualized return per year over that period of time. Easy enough. However, reality is that people don't invest at the beginning of 10 years and pull their money out at the end of 10 years. What they do is that they put money in, they take money out, they put money in, they take money out, and in many cases they're investing every month or every 2 weeks or things like that. And so it's tougher to actually get a rate of return that looks similar because of people's behavior differences. And so we call that money-weighted return. So it's your return based on when you put the money in. Let me give you kind of a basic example here. So say you have a fund or an ETF, starts at $10 at the beginning of the year. It goes down to $8, then up to $12, and then back down to $10. So your time-weighted return for that year is 0%, right? Started at 10, ended at 10, 0%. Now looking at an investor's experience, if you bought at the beginning and then held it the whole time, you would also have 0%. But if you bought at $8, your return would be 20% because you bought it at 8, now it's worth 10. However, if you bought at 12, your return would be negative 17%. I won't get into the math there. I think it might be 20%. But the money-weighted return is different based on when you bought. And if you bought at all 3 different periods of time, it'd be different again. Because your holding period is also different for each different period of time. So a money-weighted return, which is what we report in our industry, is much more accurate. It's also much more complicated. And so this report from Morningstar is taking a look at the average investor's money-weighted returns versus the time-weighted returns of the investment fund. So your investment return matters when you buy. So a well-documented phenomenon is that people will inevitably chase returns. Return chasing is the biggest thing that will cause you problems as an investor. Chasing returns means that people invest in things that have recently done well, thinking that they will continue to do so, when in reality, the gains have likely already occurred. You've seen this time and time again, largely in speculative investments, but also really benign things too. You look at weed stocks here in Canada, crypto, the meme stocks, but even sectors like last year with oil and gas or technology and a few years ago. All sorts of things happen. Once you start seeing the news headlines and you hear your buddy that made a few bucks in a certain sector or a certain stock or something like that, you want to hop into, oh, you're too late. That's called chasing returns. So this was evident in the study because the largest gap between fund performance and investor performance is in the sector equity category. So people trying to find a hot investment will typically end up trying to buy into sector-specific funds, technology, energy, consumer staples, precious metals, whatever they think is going to be hot is largely based on what was already hot last week, last month, last year, whatever. So chasing these sector returns has been the best way to lose money, according to this study. So it's the largest gap by far, with investors' returns being 4.25% lower than the funds themselves. 4.25%. That's massive. That's a huge gap. Another thing that I found interesting was the difference in active and passive funds. I know this wasn't specifically about active and passive, but they did address it. So many of you would likely expect the gaps to be much higher in active funds because of the higher costs and performance challenges with active management over time. However, in 6 of the 7 categories, which were alternatives, international equity, municipal bonds, non-traditional equity, sector equity, taxable bonds, and U.S. equities, in 6 of those 7 categories, the investor gap was actually higher, and in many cases much higher, in the passive funds. They even wrote in the report, they said that this was an unexpected trend that they continue to see. There's many different reasons why this could be the case, but I would expect this to really point to the fact that when many people are investing on their own, because most people that invest on their own largely aren't using active funds. Many active funds are in workplace pensions and things like that. Lots of advisors use active funds. Many people investing on their own are likely using passive investment funds and ETFs. When you're investing on your own, it can be really tough to manage your own behavior and emotions. It's not a flaw, it's just reality. It's hard to do. So the management style, meaning active or passive or whatever, doesn't seem to matter. The costs don't really seem to matter. It's the constant reminder here that you need to get out of your own way and out of your own emotions and out of greed and out of fear to actually have the best chances of having investment success. This is why I advocate for people using people like myself to help them with investing. It's not because you're unintelligent and can't do it on your own. It's because working with an advisor can help mitigate some of these behavior gaps that have been shown to exist across categories, across management style, across countries. So what are the main takeaways from this report, assuming that you actually want to get your share of an investment fund's return? The report itself makes the following suggestions, and I couldn't say them better myself. Number 1, focusing on holding a smaller number of widely diversified funds. They found that the gaps in these types of investments were actually the smallest, and so it led to the best relative performance for that category. That type of investing is something that I would widely advocate for anyways, but this evidence is a bit more fuel for my fire there. Number 2, which goes hand in hand with that, avoiding highly volatile funds. It just makes the likelihood of getting the timing wrong much higher. Number 3, automating your tasks of asset allocation, so that's your stocks and bonds and whatever mix you have, and rebalancing, being able to automatically rebalance as well. This is a big thing that I advocate for, and you probably heard that in my last series on building your own investment approach. And number 4, embrace techniques that put investment decisions on autopilot, such as dollar cost averaging, which means investing regularly and automatically. So they found that even though the evidence for dollar cost averaging, like if you have the money to invest, the evidence says that more often than not, you'll actually perform better if you just put the money in and let it sit instead of putting the money in over time. But most people that are dollar cost averaging are doing it because that's how they get paid. They don't get paid a lump sum at the beginning of the year or anything like that. They get paid every 2 weeks or every month, and so that's when they invest. So if you embrace that and invest when you have the money, their evidence from this report shows that you would have an increased odds of success. I'll finish off here with the final line from this report. They say, investors who follow a consistent investment approach and avoid chasing performance will likely reap rewards over time. I couldn't say it better myself. Thanks so much for joining me. We'll see you next week. Thanks for listening to this episode of the Canadian Money Roadmap Podcast. Any rates of return or investments discussed are historical or hypothetical and are intended to be used for educational purposes only. You should always consult with your financial, legal, and tax advisors before making changes to your financial plan. Evan Neufeld is a certified financial planner and registered investment fund advisor. Mutual funds and ETFs are provided by Sterling Mutuals, Inc.